I'm looking out in the distance and it appears that a recession is imminent. No, I don't have a crystal ball, but I have a very reliable predictor that has been able to accurately predict recessions over at least 5 decades. It's called the yield curve. In this video, I will talk about what the yield curve is, how it helps predict a recession, what a recession is, and what sectors are recession proof. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Subscribe to my YouTube channel and follow my Facebook page to learn how to build wealth through investing. Let's talk about the yield curve and why it is so important. The yield curve shows a graphical relationship between bond yields and maturities. Yield is just a fancy term for total return or total interest on bonds or fixed income instruments, and it includes all coupon payments. Let me show you what an actual yield curve could look like for treasuries. You can plot a yield curve for any fixed income instrument. This data is from December 2019 for treasuries. On this chart, x-axis represents maturities and y-axis represents yields. Each point on the chart represents the yield of a specific treasury security. For example, this point that says 1M shows that the yield on a 1-month T-bill was 1.48%. This point 2Y shows that the yield on a 2-year treasury note was 1.58%. This point 10Y shows that the yield on a 10-year treasury note was 1.92%. And the 30-year treasury bond yield was 2.39%. These points from left to right represent treasury securities in increasing order of maturities. On this specific chart from 2019, yields are rising with maturities. The curve is upward sloping. The yield for a 10-year note was higher than the yield for a 2-year note, and you would expect that under normal circumstances. Here's one way to think about this. If you hold a 10-year note, you would expect to earn a higher interest rate than, say, a 2-year note because of higher risk associated with a longer term. Treasury securities have almost zero risk of default because they are backed by the full faith and credit of the US government. So the risk I'm talking about is the interest rate risk. If you forgot what that is, I discussed interest rate risk and reinvestment risk in this video. A second way to think about an upward sloping yield curve is that investors who buy shorter maturity securities expect interest rates to rise in the future. So they are okay to earn less in interest now with the expectation that when their bond matures, they can roll over the money they receive at maturity into a higher yielding bond. The shape of the yield curve is influenced by demand and supply, but also by the actions of the Fed. The yields on shorter maturities, like the 1-month T-bill, are influenced a lot by the Fed funds rate. To learn about what those are, watch this video. The yields on the longer end or for longer maturities are driven by supply and demand. When investors expect the economy to do well over the long term, they are drawn to the stock market because stock market has tended to yield better returns than bonds over the long term. Part of this expectation also comes from Fed's actions. When the Fed keeps interest rates low, companies can borrow money cheaper, and that fuels growth. So the demand for stocks goes up and demand for longer term bonds falls. When that happens, the price of long-term bonds falls, and with that, yields for longer term bonds rise because bond yields are inversely proportional to bond prices. This is in a normal growing economy. Fast forward to January of 2023. This is the yield curve from a couple of days ago. Notice anything different? Apart from the fact that interest rates have risen, the shape of the yield curve is different. It's no longer upward sloping. It's inverted. The yields on shorter maturities are higher than those on longer maturities. This 2-year Treasury note, for example, is yielding 4.23%, which is higher than the 10-year yield at 3.57%. Two ways this can happen. One, the yields on longer maturities fall, which hasn't happened. Or two, the yields on shorter maturities rise, which did happen. The yields on shorter maturity T-bills rose because the Fed raised interest rates from near 0% to between 4.25 and 4.5%. This shape is signaling that interest rates are expected to fall in the future. And that's why investors are willing to accept a lower yield on a longer maturity, like a 10-year note. Because remember, they will have to reinvest at a lower rate the money they get after, say, a 2-year note matures. It can also be a sign of an impending recession. With rising rates, borrowing becomes expensive. So you will likely see a decrease in borrowing and lending. And this can slow down economic growth. When you hear conversations about the yield curve, analysts and economists are comparing yields on a longer term maturity against a shorter term maturity security. Differences between yields on 10-year and 2-year maturity treasuries are most common. But some analysts also compare yields on 10-year and 3-month maturity securities, or even yields on 10-year treasuries and the Fed funds rate. This is where you can get data on treasury yields going back to 1990. I looked at the 10-year yield in this column, and from that I subtracted the 2-year yield in this column. A positive value indicates a normal yield curve, and negative value indicates an inverted yield curve. I went back to 1976 and plotted the difference over time. Here, the green areas indicate a normal yield curve. That's when the 10-year yield exceeded the 2-year yield. And the red area indicates an inverted yield curve. That's when the 2-year yield exceeds the 10-year yield. The gray shaded areas indicate recessions. So this gray region, for example, is the great financial crisis caused by the housing bubble. This one is from the recession that followed the dot-com bubble. Notice anything? I was blown away when I first saw this. Every single recession was preceded by an inversion in the yield curve. COVID recession was different. The yield curve on the 10-year minus 2-year basis didn't stay inverted for a long time. But if you look at the 10-year minus Fed funds rate, like this one, it was inverted for some time. And even without COVID, we might have seen a recession. But again, there is no way to tell what might have happened. So sometimes it helps to analyze different maturities instead of relying on just one measure. So anyway, getting back to the 10-year minus 2-year yield chart, we can see that the yield curve inverted sometime in July of 2022. If history is any indicator, we should see another recession in the next 1 or 2 years. There is no way to predict the exact date a recession will start. There's a chance that the yield curve may become positive again, like it did here, before you see a recession. Economists have studied this over the years, and I'll link some of the studies in the description. It looks like there's a strong relationship between an inverted yield curve and a recession that follows, even though it does not necessarily guarantee a recession. And just because an inversion of the yield curve precedes a recession does not mean that the inversion causes a recession. It is a warning sign though. Here are a few possibilities. Number one, inflation cools to the Fed desired level and the Fed stops raising interest rates and we are able to avert a recession. Bond yields fall, which means bond prices rise. Existing bondholders could sell their bonds for a profit. Scenario two, inflation doesn't rein in and the Fed continues to raise interest rates, which means we see layoffs, business closures, and a tough recession. So the Fed then has to start lowering interest rates to boost the economy, which again implies higher bond prices. Now let me discuss some investments that tend to do well during a recession. But before that, please show me some love by hitting that like button and share this video with one person who may get some value out of it. And if you're new here, please consider subscribing and hit the notification bell so you don't miss any of my new videos. I post a new video every week. If you're watching me on Facebook, don't forget to follow my page. And please comment below what you like and what you want to hear more about in my future videos. It helps me rank in YouTube's algorithm. If you have questions, feel free to ask. And if you want to learn how to invest in the stock market and don't know where to get started, don't forget to watch this free course on the basics of stock market investing for beginners. I was super nervous when I purchased my first share of Apple, and I can completely understand how overwhelming the stock market can be. This course is designed to take the overwhelm out of investing. Before I tell you about investments that do well even in recessions, let's talk about what a recession is. There is no one definition of a recession. A recession is typically defined as a decline in the GDP or the gross domestic product of a country for 2 consecutive quarters. This is usually accompanied by a slowdown in economic activity, increase in layoffs, increase in unemployment, business closures, and so on. The National Bureau of Economic Research, NBER, keeps official track of recessions. So the start dates and end dates of recessions and so on. They look at a number of factors, not just the GDP. They look at labor market, consumer and business spending, industrial production, income, etc. Which is why even though the GDP declined in Q1 and Q2 of 2022, it was not classified as a recession because other factors were still strong. We are not currently in a recession, but there are a few indicators that I will be watching for, such as the yield curve, employment reports, manufacturing PMI, industrial production, and so on. If the recession is short-lived, it's not even announced until way after it's over. So you can't rely on NBER to predict a recession. Some industries tend to be recession-proof. Defensive sectors such as healthcare, utilities, consumer staples, they tend to withstand recessions. These are the sectors that will see profitability even when other sectors are in decline. People get sick and need healthcare even during recessions. People will buy food or groceries even during recessions. The demand for utilities like gas and electricity will also be stable during recessions. So if you own these sectors in your portfolio will perform well in recessions. On the other hand, if you're overweight cyclical sectors that do well only when the economy is growing, your portfolio will underperform in a recession. And while these defensive sectors tend to perform well, not every single company within those sectors will do well. The companies that are financially strong will tend to thrive. And another factor you want to look at is relative valuation. Just because a particular sector tends to outperform the broad market during recessions does not mean that valuations will be attractive. Recessions are times of uncertainty, so there is flight to quality, and you may see an increase in demand for treasury securities, and prices of treasury bonds tend to increase. I talked about why this is a good time to buy T-bills in this video, so in case you missed it, go watch that video. Also, prices of gold or other precious metals may increase during recessions as investors tend to seek safer, stable investments. But because there is no way to tell in advance when recessions begin and end, it's important to have a well-diversified portfolio. Create an investment plan to understand your investment goals and constraints. Watch this video to learn how. Invest for the long term. The US has seen multiple recessions over the years. I talked about stock market crashes in this video that may be of interest. Go watch this video next, and if you found any of this information to be of any value, please like this video and share it around. I want more and more people to start thinking about investing for the family's future. And as always, don't forget to be happy, to be kind, and to be your best self. Bye.